Hey everyone, this is John Hansbrough and Alex Rasmussen with the LBL group. We're here to talk a little bit about the Secure Act and retirement planning moving forward. Alex, how are you doing today?
I'm good, John. How are you?
I'm good. I'm good. So we're here to talk about the Secure Act. Can you tell us what that is? What is it about?
Sure. So the Secure Act, it stands for Setting Every Community Up for Retirement Enhancement. Sorry, acronyms. I had to refer to notes there.
Yeah, it's a
So
mouthful.
it's a piece of legislation that they enacted at the tail end of 2019 that changed retirement plans and retirement in general in a lot of different ways. It's the biggest piece of legislation since about 2006.
Mhm. Got it. Okay. Yeah. And so if we just jump into the provisions, I mean, it sounds like it was a big piece of legislation. Do you want to start with a couple provisions that stand out for what it changes for retirement planning?
Sure. So one of the bigger ones that affects a lot of people, whether they're working or not, just when they turn 70 and a half, it used to be that they had to take required minimum distributions. And so they can't essentially pass off all of their retirement earnings and savings to future generations. The government wants to make sure that they get their piece, especially when it's all that tax deferred money.
Mhm.
So the Secure Act actually pushes that age back. So for those people who turned 70 and a half January 1st of 2020 and later, they can now wait till they're age 72, which was
Got
nice.
it. Okay. Got it. Besides that, did it have other impacts on IRAs?
Yeah, another one is stretch plans for beneficiaries, non-spouse beneficiaries specifically. So when somebody passes away and they don't have a spouse and they leave their retirement assets to, let's say, their kids, their adult children, it used to be that those adult children could stretch the distribution of those retirement assets over their lifetime. The rules for that have now changed. They need to distribute it over a 10-year period max. There are a few exceptions to that. So if it's a non-spouse who is less than 10 years younger than the decedent, then they don't, that rule doesn't apply to them. Children are not restricted to that 10-year period, and disabled persons. So basically, myself, for example, if my parents were to pass away and my last remaining parent had left their IRA to me, I would have to deplete that IRA within 10 years. And the reason why that's significant is because every year that I take money out, I'm paying taxes on that. So it's not as beneficial anymore, but again, there are some exceptions to that.
Got it. Okay. Cool. And then besides IRA plans, can we talk a little bit about 401k plans? I'm sure it's changed a lot for them, right?
Oh yeah. So one of the big ones is startup tax credits. That's my favorite one, actually. Especially with a lot of larger companies and even smaller companies that have been hesitant to start retirement plans. One of the biggest reasons for that is because they are more costly in the beginning. There's not any assets to charge lower percentages from, so the service providers can afford to service them. So the percentages for fees that are charged to those plans are often a lot higher at the start of a retirement plan. So people can generate that income from it to service the plan. And it takes a while to get a plan off the ground. So there were some tax credits originally, but now they've been amplified, which is really great. So the first one is for small plans or smaller employers of 100 or less employees.
Mhm.
If they start a plan, now they get $500 or up to $5,000 to recoup implementation costs
Mhm.
over a 3-year period. And that's going to mainly depend on how many non-highly compensated employees they have. There's some certain formulas. I encourage people to talk to their tax professional to calculate exactly what their tax credit would be,
Mhm.
but they're definitely a lot bigger than they used to be.
Got it.
And
Okay. Yeah, that's
that's for
huge.
smaller employers.
Yeah. And so that incentive, I'm guessing then from the government, they're trying to recognize that people need to save more for retirement. They're trying to incentivize that, huh? Yeah. Are
Right.
there other, what kind of other incentives did it put into place for retirement savings?
So the other one is for automatic enrollment.
Mhm.
And this is another big one that we like in our industry. Automatic enrollment is just that extra little nudge that participants need to actually save for retirement. So what happens is we let them know, hey, once you're eligible, we're automatically going to put you into the plan at, let's say 5 or 6% of your income is going to automatically be deferred to the retirement plan. You can opt out, but if you do nothing, this is what's going to happen. And so that's taking more of that paternal role to say, hey, employee, you need to save for retirement. We're going to help. We're going to put you in there. You don't have to do anything. Sort of like Social Security, right? Nobody had to sign up for that. So now if you set up auto enrollment on your plan, even if it's an existing plan, there's a tax credit available for that too. And the reason for that, there's some employers that sort of don't want to tell people what to do. And that's not what this is. Most people, I would say, that I go out and do education for, they all want to save for retirement. They know they're supposed to. It's just they don't do it out of fear. They don't know what 5% of their gross pay is. So they feel like they can't afford it. When in reality, people know what their paycheck is by the hundreds or the $1,000 that they get each week or each pay period, but they never know what those last two digits are. Like I bring home 2,200 and something. Well, what is that something? That could be that 5% that you won't even miss, because people
Mhm.
aren't accounting for their expenses to those slight dollar amounts for the most part.
Right.
And the other issue that we have is just, it's one of those things where it's like retirement is so far away. So it's sort of in the list of daily things to accomplish and that people have to do with their jobs, their kids, and their household chores and everything else, just putting dinner on the table. That sort of that that duty is pushed to the very bottom of the list. And before you know it, 10 years have gone by.
Mhm.
And they wish they had done it sooner and taken the time out to do it. And it's not, the issue is not that it takes long, they just didn't prioritize it. So auto enroll basically has us stepping in and prioritizing it for them, and they don't have to lift a finger.
Yeah, that's awesome. I mean, you're seeing that a lot, right? With behavioral finance, they talk about those kinds of things. Like if if I basically, every time I got my paycheck, if I actually had to write out that contribution to my 401k, it might not happen every time, but the fact it just gets taken out automatically is great because I
Yeah.
don't think about it. And I just get used to
Right.
the amount that's, after the fact, after that
Yeah.
deduction. So they're great for saving.
Right.
So besides, I think there was something about part-time employees that are impacted in their ability to participate. What is that about?
So there's the Secure Act addresses very, very, very part-time employees, and it's people who work 500 on average 500 hours a year, which is less than 10 hours a week.
Mhm.
And what the Secure Act wants to do is put more people into plans. That's why there's an incentive for auto enroll. There's an incentive to start a plan. We know there's an issue in this country with people not taking charge of retirement savings or any savings for that matter, if you want to get into it. And so what they want to do is make sure that retirement plans are opened up a lot more. Sometimes employers try to close them off because they are giving their employees some kind of additional benefit, like a match or non-elective contribution. And they don't want to just give it to, the part-timers that are only there for a little stint and then they're going to leave. And then they've
Mhm.
invested this money into these employees that never had an intention of sticking around for the betterment of the organization anyway. And the Secure Act is basically opening it up more, so they kind of have to. And I think in all likelihood, it's actually going to complicate things a lot more from an administrative perspective.
Mhm.
Because now people have to track those hours very tediously and over a long period of time. So it could be helpful for some people, but if you think about the average amount of time that people are spending in those positions, it's probably not that long anyways. Maybe somebody heading into retirement that isn't really trying to save that much, or maybe a younger person that is just dipping their toe in the in the workforce, that
Mhm.
those are typically what you see of those positions. So it'll be interesting to see how that's actually handled from an administrative perspective.
Right. And then, yeah, how it impacts employment patterns and stuff like that too, I'm
Right.
sure. So besides regular 401k plans, we haven't talked about plans for like nonprofits, 403bs. Is there any impact on those?
Not as much because 403bs are less restrictive anyway, because they are for nonprofits. You have to let people into 403bs right away, even the part-timers. So there wasn't really that much of a need to open it up even further.
Got it. Yeah, it's actually making 401ks operate a little bit more closely to 403bs then, huh?
Right, a little bit, yeah.
Yeah. Got it. So then what about changes to what you can and can't invest in within a 401k? For example, like annuities, like in-plan annuities. Are
Mhm.
those available now? What's the deal with those?
Yeah, in-plan annuities are more available now. I don't know what that's going to do to utilization. I personally, we in our practice, in our retirement plan practice, we focus a lot on education. So we're going out, actually talking to the employees and everything. And my plan sponsors know that when they have people that are about to retire that are like, what am I allowed to do? They send them right to Alex, and Alex, in case anybody forgot. So they send them to me and my team, and we explain, these are all the different options that you have for distribution and ongoing management. And we always encourage people to work with a financial professional rather than trying to guess at how to make your money last forever. And annuities can be really great tools for long-term retirement planning to make sure you always have a paycheck. But you got to understand what kind of annuity you have, because there's a million and one different flavors. It's like ice cream, right?
Yeah.
And there's different costs associated, and you want to make sure that you truly understand those as well. So how many more people are going to actually take advantage of those in-plan annuities? I'm not really sure. One of the good things about the Secure Act changes to in-plan annuities is they have restricted the fees for transferring it. So if you had an in-plan annuity and you wanted to terminate that to go somewhere else or transfer it somehow, they used to charge all these back end charges. And that's one of the dangers of not fully understanding your annuity, any annuity
Mhm.
for that matter, is there are often charges for early termination of the contract.
Mhm.
And, those percentages often go down within that holding period. But if you get out sooner than you're supposed to, you're going to pay a hefty fee for that. So what they did is they got rid of that. So that is one really helpful thing that the Secure Act did. But as far as how many more are we going to see, I don't think that many more. I think it's just more important that we encourage people to stay educated on their options.
Yeah. Got it. And then like to that point, kind of with annuities, creating future income. And I remember I was actually in DC talking to legislators about this. They included an annual disclosure on projected income from your 401k plan, correct? Is that now a piece of it?
Yeah, so thanks for bringing that up. So now there is an annual disclosure of projected income that's required by the different record keepers to show on retirement plans. So when you log into your John Hancock, the Standard, Transamerica, Principal American Funds website to see your 401k statement and all of that information, then this is something that most of the industry was already doing. They're showing these like gap analysis charts, and it's basically projecting the amount of income that you're going to need at retirement. And record keepers have a certain amount of information about us. They know everything about us.
Mhm.
They
Yeah.
know how much we make because they're getting those payroll files. They know how old we are. They know what approximate retirement ages, and they know how much you're deferring and what level of risk you're taking at that stage in your life. So what they're doing is applying a lot of generalizations, and that's an important thing to consider here, is they're very generalized and they're making a lot of assumptions about what's going to happen in the market. How much more is this person going to save? Are they going to increase? Are they going to decrease? Are they going to inherit any money? There's a lot of details that are pretty significant at the end of the day that just aren't accounted for. But based on these generalizations, they're creating this analysis of your projected income needs at retirement based on what they do know and where you're at. And they're saying, hey, you make X amount of dollars and you have 10 years until retirement. You're going to need 80% of that. And you're on progress based on your account here to make, only 70%. So you have a 10% gap in income need. And they're showing that already. But as I mentioned, there's a lot of different things that are not mentioned, and a lot of details that are very, very important, like outside balances, emergency situations that pop up if people pull out money early for before they even retire,
Mm-hmm.
if they are due to inherit a bunch of money, if their spouse has retirement, maybe that one person is saving for two people and they're way shorter than 10% behind, or a situation like that.
Yeah.
But given all that information, most people know that these are generalizations. It's disclosed right there in front of you. I don't know if they read it, but it's still very helpful for people to say, whoa, I'm only meeting 20% of my income need goal for when I retire.
Uh-huh.
And, if it's a huge difference, there's probably something to that they can take from that and say, I need to really amp this up, or they'll just continue to bury their head in the sand and ignore it. Who knows?
Right.
But the information is there. We're trying to do our part in as much as we can to give people more information and give them that nudge that makes them do the right thing.
Yeah. That's probably a hard thing too, right? I mean, you have people who they're looking at their 401k balance and you're trying to convert that into what that's going to mean in the future for income. So I'm sure it's going to be helpful in some ways, getting people to incentivize them for better savings, right?
Right. I hope so. I need all the help I can get.
Yeah, that's the hope. Yeah.
Educating the masses.
So another area I wanted to talk about was multiple employer plans. So I think this is a really new provision of the Secure Act. It's a new thing in retirement planning. What exactly do those mean, and what do those do?
So multiple employer plans are fun. They actually already exist, MEPs,
Mm-hmm.
closed MEPs, if you will. And what they are is pool. I don't want to say pooled because that's the other thing. It's one plan for multiple employers to have cost benefit from. So basically, there's a plan document. Sometimes it's set up where each EIN that adopts into this multiple employer plan can choose different plan provisions. Like if they want a different eligibility than the other guy that's also adopted, then they can do that. And there is some wiggle room on that. But the benefit is everybody's getting together to lower those costs. Because as mentioned earlier, those startup fees can be pretty high. You take into account the expense ratios, which is going to happen no matter where you go, even though they're discounted because it's in a retirement plan and it's still cheaper than a retail product. You're also paying for record keeping, sometimes a third-party administrator. You're paying for an advisor, and there's a lot to that, and it costs money to run these plans. So any opportunity these startups or other smaller employers can get to kind of get together and lower those costs because they're using everybody's assets, it's usually invited. The issue with multiple employer plans before is when they would go through testing, administration, audits, and all of that, if there was what they call it is the bad apple theory.
Mm-hmm.
And if you had one bad apple, one employer that just violated the terms of their plan, and they were committing atrocities on the retirement plan, or doing all these terrible things, they were the bad apple, it would disrupt everybody. And one thing that the Secure Act did is they got rid of that. They're saying, hey, you have one bad apple, then we'll kick them out. Everybody else is good. So that's a really great thing, because then more people are likely to adopt into those multiple employer plans, which is helpful, if you're trying to cut costs. Pooled employer plans are a little bit different because multiple employer plans you had to have something in common. So like a franchise, work with a lot of fast food restaurants, and you have McDonald's, and a bunch of different McDonald's franchise owners are all part of the big McDonald's plan. that's, you know, that's something in common. They're part of the same, you know, corporate structure essentially, but they're franchise owners. That was required for multiple employer plans, but pooled employer plans, it's still, you don't have to have that commonality. And it's a potential game changer for the entire retirement world. Because now at this point, you know, me, Alex, as the advisor could say, hey, I want to create a pooled employer plan, and all of my little startup plans that have, you know, basically any assets. I could take one of my plans that has $10 million and put them in. I could take one of my plans that has $200,000 in it that's paying higher fees, and put them all in a pooled employer plan that I manage. And that they don't have to have a commonality. They don't even have to be in the same industry or anything else. I'm the commonality there. And the only thing that is still a little, you know, that we're trying to iron out a little bit is who's going to be the fiduciary and the full plan sponsor. And can somebody like an advisor who obviously has some kind of conflict of interest in the entire management of the plan, can an advisor be the plan sponsor and get paid on it? You know, in certain situations like that, we have to kind of iron out those details. But, you know, depending on how favorable they are for different situations, it could be, again, a huge game changer.
Yeah, that's really interesting to think, you know, like anything, right, where the risk lies then. So who's going to be responsible on the compliance? You know, if there's a form that's not filed or participant contributions aren't made, who's on the hook for that? So yeah.
And nobody ever wants to be on the hook.
Yeah, everyone wants to hand that off to someone else, right?
Yeah, everyone wants to get paid, but nobody wants to be on the hook.
Yeah. So speaking about compliance, so one of those forms that, you know, most 401k plan sponsors are probably familiar with is the 5500. I think there's been some changes to filings of 5500s, correct?
Yeah. So consolidated 5500 is going to be possible for the PEPs or the MEPs, as long as it's a defined contribution plan, like 401k. So not like a pension or something. It has to have the same trustee, fiduciary, administrator. Plan years need to be the same. So, and most plan years are January 1st to December 31st. So that's fine. And the same investment option. So as long as everybody has the same, you know, mutual fund lineup, then they'll be allowed to file 15500, which again, another huge cost cutter. Because you're thinking about audits and everything that goes along with that, rather than each adopting employer paying those administration fees. As long as they're okay with doing what everybody else is doing, you know, you're taking away some of their choices, but you're lowering their fees. You know, some people love it, some people won't, but it's nice to have options.
Got it. Okay, cool. So moving on from those provisions, there's a new mandate, right? Part of the Secure Act is a mandate that some companies are going to have to offer a 401k plan, just like they're required to offer benefits. Can you like lead us into that? Like what's going on there? How does that work in California, for example?
Yeah, so some states already have this implemented in different ways. California specifically has CalSavers, and it's a California-run retirement plan. And basically, it's a Roth IRA. It has the same limits, contribution limits as a Roth IRA. It has the same income limitations. So if you're somebody that's highly compensated, or you're married to somebody that you file taxes with that's highly compensated, then each employee needs to know what they're allowed to put into this CalSavers plan if that's in fact what they're that's available to them. Large employers actually have a deadline of this year to set that to enroll their employees or opt out because they are offering a qualified plan. So that's the thing. California is making large employers with more than 100 employees they're making them create a plan, or you're doing CalSavers, pick one. And they're penalizing them if they don't do it either. So if you are one of those employers, you got some quick decisions to make here. But you know, there's some pros and cons to the CalSavers thing. The pros are that the employer has very little administrative duty. So their only administrative duty is to auto enroll the employee. So they have to receive notification that they're going to be auto enrolled. It's up to the employee, again, just like 401k auto enroll, to opt out. And as long as they don't, the employer is on the hook to put their employees in there and set that up through like their payroll company. And I think, you know, all the payroll companies out there are making it quite easy to do that, but it's still some kind of administrative duty that the employer has on their plate. One of the other benefits for the employer is that it doesn't cost them anything aside from the actual payroll, you know, repercussions, whatever their payroll company might charge them for this process. But aside from that, the plan itself demands no fees or anything from the employer. They're not obligated to match anything. They're really not involved at all. Even if the employee puts in money and it turns out that they make too much money to contribute to a Roth, the employer has nothing to do with that. It's not on their shoulders. So no responsibility.
Yeah.
So that's one of the more favorable things about CalSavers. I always argue that there's more non-favorable things about CalSavers, and one being that it's Roth only, which is really great for a lot of reasons, but for people looking for those tax deductions, obviously that doesn't help them at all. And they don't allow for pre-tax contributions at all. So that could be a potential downside. The other downside is you're limited on your contribution. So if you wanted to contribute more than a regular Roth IRA or that amount, you can't. You're stuck. The funds are chosen by the state. My guess is there's going to be a lot of municipals, things like that. The other thing is costs. You know, the costs are set by the state, you know, whatever the plan that they've adopted, and the employer can't shop around and see what works best for them or anything like that. And then also, you know, there's not anything encouraging for your employees. So, you know, one of the big reasons for having or offering a retirement plan is it's a benefit. It makes you more competitive and you're attracting top talent. And if all you're offering is CalSavers, that's not a benefit for most people that are, you know, shopping around, comparing benefits and things like that. You know, all other things, even salary and everything else, if there's a plan that's offering a safe harbor match, that's way more beneficial than a CalSavers plan. So, you know, all of those things are a consideration. And I just encourage people to consider them thoroughly and not just go off of, well, this is cheaper.
Yeah.
Cheaper's not always better. We know that.
Totally. Yeah. You get what you pay for in a lot of ways. So if a company wants to avoid CalSavers and they want to actually set up a plan for their employees, what does that usually look like? Which kind of plans qualify?
So 401ks, 403bs, if you're a nonprofit, SEP IRAs, and even simple IRAs. Simple IRAs are for smaller employers with less than 100 people. There's different contribution limits on there. The employer is required to offer a match, but it's smaller than, or it can be smaller. But it operates a little bit more like an IRA, so most of the cost is pushed off to the investor rather than the employer. 401ks and 403bs are much more flexible in terms of cost, in terms of provisions, in terms of contribution, employee and employer. So, you know, a lot of times they work better. And then obviously if you're an organization that anticipates being over 100 employees, you would have to have a 401 or 403b anyway. And then SEP IRAs, you know, those are available. They make the most sense for those like husband and wife teams where they benefit themselves because there is no employee contribution. It's only employer. So if you have 10 employees and they wanted to defer their own money, they can't. So by effectively only offering the SEP, you're limiting what they can save for themselves. And it's very generous to give all of your employees something, but you can't discriminate. You have to give all of them something, or you give all of them nothing. And if it's one of those years where you're giving them nothing, you're also restricting them from saving themselves. So that's the kind of caveat with that. That's why, again, you know, husband and wives, if it's just a team of two, let's say they're realtors, and then that makes a lot of sense because their company account can pay them. They're the employee and the employer, so they don't care if they're contributing as an employee. So it works really well for a situation like that.
Got it. Okay. Yeah. So there's definitely some considerations based on like company makeup, demographics, all that kind of stuff. It's harder to pick something off the shelf. You really got to understand what's going on with a specific company. Huh.
Yes, absolutely.
Got it. So that kind of really well covers, it seems like, retirement plans. Are there other plan changes or anything else like that to kind of point out with regards to the Secure Act?
Yeah, so 529 plans, this isn't really retirement related.
Right.
Yeah, no, not really. So 529 plans are college savings vehicles where the interest earned is used tax-free as long as it's for education expenses. And they're defined by the IRS. And what they've done is they've opened it up to student loans. Thank goodness, really. As somebody who had student loans and successfully paid them off, this is kind of great. If somebody had to take a student loan, but then it turns out that grandma had a 529 plan started for them, they can use that money to pay off the student loan, which is really great. And it without paying the taxes on the growth of that 529 account. The only thing is if for some reason you're writing off that student loan interest on your taxes and you use the 529 money to pay it off, you can't write off the interest anymore on your taxes. But if you they limit how much of that you can do as well. So if you make too much money and you're still just working on paying your student loans off, it doesn't matter anyway. Use the money to pay off the loans rather than waiting for the next person to go to school and use the money.
Right. Yeah. Especially because like student loans, you're usually having a pretty decent interest rate on those loans, right?
Yeah, I mean, depending on when you got them. I know I initiated mine like more than 10 years ago. Let's not talk about that. And so, my interest rates when I got it, they were over 6%. And that was a bummer,
Yeah.
So if you can get rid of the interest, then, that's obviously better off, especially with earnings that are not taxable. No better way to use those earnings.
That's a huge deal, right? Yeah. So that makes a huge difference. Besides that, is there other things affecting 529s or other retirement plan features?
Not that I can think of right now. There are just in relation to the Secure Act in general. Another added benefit is if there are hardship withdrawals that you can take from retirement plans, and those were already predefined by the IRS. For medical bills and to avoid eviction, purchase of a principal residence. They added another one which is for birth or adoption. So, which is great because separate subject. There's a lot of kids in that system, and it's a nice way to encourage people that want to get them out. So.
Yeah, totally. You mentioned penalties. I feel like that's obviously the not fun topic. What are the penalties for companies not being compliant with some of these new provisions?
So for late filing, and things like that, they're bigger than they were before. So in short, just stay compliant, do all the stuff by the deadlines and you're fine. Yep. No penalties because they just keep getting bigger.
Right. Yeah. Yeah. It's definitely, you don't want to brush them under the rug. They'll just keep growing and getting worse and worse and worse.
Yes.
Got it. So, so what kind of final is, like, we're closing here today? What are the final takeaways you have? What should companies be thinking about, asking questions about? What should be on their mind?
Just kind of touching back on CalSaver. So companies of over 100 employees, their deadline is this year. So September 30th, 2020, you have to have at least a plan document in place. Should be further along than that. So, I mean, we got, I don't know, like a little over a month to make some decisions. I always recommend anytime you're starting a plan, get different quotes from different places. Use a financial professional to do that for you because it is a lot of legwork. You're going to need to provide the person a census to get a really good feel for what kind of plan you should have. Don't be afraid to look at those numbers for matches and things like that. There's so much tax savings on the table in retirement plans for the employer. And then all the different tax credits that we talked about. So it may not cost as much as you think. Don't write it off. If you don't make the deadline, you can still start a plan anytime. You're not locked into Cal Savers forever and ever. So, if you need more time for due diligence, just make sure you are ready to go for Cal Savers, and then reach out and do the homework on the plan. And, this year we had COVID that really impacted people very, very negatively, their organizations. And maybe this is just the worst possible year for you to start a plan. That's okay. Don't write it off. You're not locked in. Again, you're not locked into Cal Savers. For those employers that are 50 to 100, your deadline's in June of 2021. I don't know if they're going to extend that. So now's a really great time for you to start looking too. So you're not putting it off to the last minute, because that's going to be the really tough thing, is when it's put off to the last minute, you're on the hook to make some major decisions for your organization that are, they are a cost to you. It's for your employees. You want to make sure you give yourself enough time to do the right thing. So start early, and, then you can feel more relaxed in the process and comfortable with the decisions that you make. And then for people who are 50 and under employees, small employers, your deadline is in 2022. So it's never too early to start looking at that either.
Right. You got
for
some
anybody,
time.
really. It's a conversation that should be had. It's a way to recruit and retain top talent, which is always going to be good for your organization. Write-offs are always good for an organization, especially in California with one of the highest tax rates for businesses. So let a financial professional help you. Somebody that really knows retirement plans, that centers their practice on retirement plans. And trust the partnerships that they have as well, because it just makes your life easier when you actually have the plan. You don't want everything to fall on your plate, and that can very easily happen when the wrong people are chosen.
Yeah. Yeah. So if someone has more questions, if they have some follow-up, or they've got a specific question about their own situation, what's probably the best way to get in touch with you?
Email's good. Phone calls are good. I return phone calls pretty quickly. Same thing with emails.
Yep. Got it.
Cool. All the normal ways.
All the normal ways. Yeah. Everything but a carrier pigeon.
Yeah. We can do happy hour and some other time and space or something like that. Lunches, love lunches.
Yeah. All right, great. Well, Alex, thank you for your time today. I appreciate it. And we'll talk to you soon. Okay.
Thanks for having me, John. Take care.
Bye.